Okay, I think we are recording. So, good evening, everyone. This is Jatin Rao, and tonight we are going to be uh, completing the discounted cash flow model that we have been working on for the past 2 weeks, the past two sessions for UFA investment teams. So, where are we right now and what are we actually going to be working on? So, in the first two sessions, we looked at this model. We are valuing Coca-Cola, and there are a lot of moving parts to this model, but the main objective of those two sessions was to calculate one of the two main pieces needed for a DCF valuation. So the first piece, as you all know, is a schedule of future free cash flows, whether those are unlevered or levered. We calculated unlevered free cash flows. So that is the first piece, is a schedule of free cash flows. What are those cash flows and when those cash flows actually occur are very important. And we achieved the first part of that at the end of the second session yesterday. The second really important piece, which we kind of sped through yesterday, is the appropriate discount rate to discount those future cash flows back to the present day. And as you all know, if you are valuing an asset and you know that this certain asset has certain future cash flows, and if you discount those future cash flows back to the present, what you get is the present value of that asset. For a company, that is called its enterprise value, which you can then convert into its implied equity value or its implied market cap, and then divide that implied equity value by its shares outstanding in order to get an implied share price based on your own fundamental valuation of the company. So at the end of last session, this is yesterday because I'm recording this on April 4th, we finished the unlevered free cash flow schedule. And there's a lot of parts to it, but it's pretty simple if you look at it at a 30,000 foot level. You have historical and you have projected numbers, and your whole goal is to get from revenue to unlevered free cash flow. So let me do a quick overview of the model as we have put it in, and then we will continue on. You are free to skip this part. This is a recording that I am doing independent, outside of our usual meeting time. So this is the time where I am going to go a little bit more into detail of some of the specifics and some of the more difficult concepts of a discounted cash flow model. But this will allow me to compact more content into a shorter time format, and you sitting at home can watch the video, pause it, rewind it to your heart's content, have it up on another screen and follow along, or just sit back, relax, and learn the art of finishing a DCF evaluation. So at the end of session 2, if you haven't already, I highly, highly recommend that you watch the recordings for the first and the second session, and that you go ahead and fill out what we have so far. We kind of sped through the weighted average cost of capital piece. Don't worry, we will do that all again today. So we filled out some basic information about Coca-Cola. And then we put in historical numbers for revenue. We projected revenue growth numbers for our projection period, which is 5 years into the future, 2023 through 2027. And these are just guesses, really. And using these revenue year over year growth numbers, we were able to project revenue we were able to project revenue for that year. We were able to project EBITDA and EBIT, or operating profit, into the future. We did this also by relating them to revenue. So for EBIT, we pulled these numbers straight from Coca-Cola's income statement and found EBIT margin, which is EBIT as a percentage of revenue. And then we made estimates for what EBIT margin would be into the future. I believe we use a rolling average here of the previous 3 years EBIT, and then multiplied this projected EBIT margin by our revenue forecast for that year to get our forecast for EBIT. Similarly, we calculated taxes. Now, these taxes were based on an effective tax rate. So we have historical effective tax rates here. We have future effective tax rates, or our predictions of what the effective tax rate is going to be. And then all we did is simply multiply this tax rate by our EBIT forecast for that year to get our taxes. And once we deduct taxes from EBIT, if you deduct taxes from EBIT, you arrive at NOPAT, or net operating profit after taxes. If you deduct taxes from EBT, or pre-tax income, that gets you to net income, right? But that goes down the path to calculate levered free cash flows. And we are on the path to calculate unlevered free cash flows, because we want to calculate the cash flows that Coca-Cola generates that are available to all capital providers of the business, both debt and equity capital providers, not just equity holders. If we had initially deducted interest expenses before calculating taxes, which eventually culminates in calculating net income and then calculating levered free cash flows. Levered free cash flows are only for equity holders. Unlevered free cash flows are available to all capital providers, namely both equity and debt. That and debt part is very, very important, which is why we don't deduct interest expenses initially. And that's also why for our historical taxes, you cannot take these 3 numbers straight from Coca-Cola's income statement, because Coca-Cola's income statement taxes are lower than they should be. Well, are lower because interest is deducted before they take taxes on them. But we don't want that, right? Because Coca-Cola's income statement finishes with net income, not net operating profit after taxes. But we want to calculate NOPAT. So we calculated taxes, we deducted taxes from EBIT, and we arrived at NOPAT. Now, this is our proxy for net income, but remember that the income statement is not an accurate representation of how much cash flow the company generates. It is accurate for how profitable it is, but profitability is very different than cash flow generation. Why? Because there's lots of non-cash expenses on the income statement, which we account for by adding back non-cash expenses such as depreciation and amortization or stock-based compensation, which are recurring non-cash expenses on Coca-Cola's income statement. So you add D&A and stock-based compensation back to NOPAT to account for how much cash they actually have. So the way that we did that is for D&A, we pulled depreciation and amortization expenses straight from Coca-Cola's cash flow statement, from their operating section of their cash flow statement. And then for the future, we backed into D&A by projecting out EBITDA and projecting out EBIT, and D&A is just EBITDA minus EBIT. Similarly, for stock-based compensation, we pulled them straight from the cash flow statement for Coca-Cola, also available in their operating section of the cash flow statement. But the way that we projected it was based on revenue. So this was, we projected stock-based compensation as a percentage of revenue, and then in the future, I'm pretty sure we said it was going to be a locked percent, 0.7% in the future. And then we multiplied that by revenue to get our approximation for stock-based compensation. I realized that this should actually be because it's a formula. Okay. So that's two ways that we account for the differences between accrual and cash accounting to calculate how much cash Coca-Cola is actually going to be generating. Another way that we do it is by calculating changes in net working capital. So at the end of, well, during last session, we talked a lot about building out an NWC, a net working capital schedule, where we project current assets and current liabilities. Well, not project, we calculated current assets and current liabilities for working capital historically, and then we projected these numbers out into the future as a percentage of revenue. And what is important is the change in net working capital, because those are actually cash transactions. So from 2020 to 2021, if cash is increasing, because this is a positive number, that means that net working capital must have decreased, which means either current assets decreased or current liabilities increased. If you want more detail on that, watch the previous recording, watch the most recent recording, the part 2. So you'll see this is the previous, this is F16 minus G16, which means that it is the previous year's net working capital minus the present year's, which accounts for a positive change in cash if it decreases and a negative change in cash if it increases. Okay, the last piece is capital expenditures. Companies generate income, they generate profit, but if they actually spend all of that profit on a new building, that means that they didn't actually gain any cash, right? So you also have to account for recurring capital expenditures. I believe here we accounted for net CapEx, which is on the cash flow statement. I'm on the balance sheet right now. But on the cash flow statement, both purchases and proceeds from disposals of property, plant, and equipment. This is sort of what they consider to be CapEx. So actually what I'm going to be doing, so the first quick fix I want to make here is I want to convert these into negative numbers, because these are shown as positive numbers because these are expenses that we're adding back. Changes in net working capital are shown as positive numbers if they increase cash and negative numbers if they decrease cash. So generally, you should stick to one accounting standard. Now, technically, that's not 100% true, because here we have taxes as a positive number, but that's totally fine as long as you clearly show in your formula what you're doing. Here, I'm just going to, we had CapEx initially as a positive number, but I'm going to convert it to a negative number to show that CapEx is an outflow, usually. So I'm going to make this an outflow, no worries. I'm going to convert these percentages to positive percentages. And over here, I am going to convert these into negatives right here. Yeah, boom. And then a really important piece is right here, we have to make this a plus sign, if you remember. So now our final, So now our final calculation, so now CapEx properly shows as a negative number. This is just the way that I like to do it, but you can do it whichever way you want. So now our final calculation for unlevered free cash flow is going to be NOPAT plus depreciation plus stock-based compensation plus any changes in net working capital plus the change in cash due to capital expenditures. So this shows as NOPAT plus D&A plus stock-based compensation plus change in NWC plus CapEx. And that is the same for all of these years. Great. So now we have unlevered free cash flows. Now, the important part is, what do we actually discount them by? So this gets us to our weighted average cost of capital. Here, I'm going to take a break, and I'm going to explain weighted average cost of capital really quickly. Make sure I'm still recording. So what is the weighted average cost of capital? What is the discount rate, essentially? So when you have an asset and you have future cash flows for that asset, the main question is, how do you discount it? What should the discount rate be numerically, and why should that discount rate be that number? Two very important questions. So we know that we've said that the appropriate discount rate for a corporation's unlevered free cash flows is the weighted average cost of capital. But we haven't really said why the weighted average cost of capital is the appropriate discount rate. And part of that is the definition of WACC in and of itself. But let me explain it this way. The discount rate for any asset's future cash flows should properly represent the riskiness of those cash flows being achieved. So let's say you were investing in a plot of land, and let's say you were going to rent out that land, and that land's rent was written down in a contract, and your whoever takes over that land or whoever rents it out from you, they're true to their word. They always pay on time. Those rental payments are always going to be less risky, right? So if you were trying to figure out the present value of that plot of land, and you know what you're going to be charging in the future, you know how many payments you're going to be getting, you know what the size of those payments are going to be, and you know that whoever is going to be renting it out from you, say you already have a tenant picked out, and you know that that tenant is good, has a very good credit history, so on and so forth, and that they're good to pay. The appropriate discount rate for that tenant is going to be decidedly lower than the appropriate discount rate for a tenant with bad credit history. Because if they don't pay, that means that your future cash flows, the cash that is coming to you, is more risky. You're more at risk of not getting your initial cash flows. So your discount rate is going to be higher. And when discount rates increase, that means valuations decrease, because cash flows are going to be discounted at a higher rate. That's simply how the discounting math works. A higher discount rate is bad as an investor, because if you are buying a plot of land, that means that your land, if you are leasing it out to a bad credit history tenant, that means that that plot of land or that apartment or whatever is worth less to you as the owner of that land or apartment. So the same theory, the same practice also applies to companies. So the question is, what is the appropriate discount rate for a company's unlevered free cash flows? Well, there is some valuation science and valuation theory behind it. And if you're really curious about the specifics of the weighted average cost of capital, take a class on valuation if you can, or just look up valuation theory and look up what weighted average cost of capital is online or on YouTube and why WACC is more appropriate. But here's a summarized version of it. Maybe if you look online, you will get a better explanation than I'm about to deliver. But my job is to simplify, so I'm going to do just that. The rule is that the appropriate discount rate for a firm's cash flows is the weighted average cost of acquiring capital for your business. I'll say that again. The appropriate discount rate for a firm's cash flows is the weighted average cost of acquiring new capital for that business. Now, maybe that's not a perfect definition. I did not look this up whatsoever, but let me explain, okay? So how are firms financed? They're financed in usually one of two ways: equity or debt. Either the firm issues equity, so stockholders, or the firm issues debt. So it goes to a bank, it issues loans, or it issues a bond, all debt securities, right? So the firm acquires capital in two ways, equity and debt. There's also preferred stock, which is a mix between equity and debt. But for most companies, and especially in the case of Coca-Cola, where there's no preferred stock, it's just equity and it's just debt. Okay. So if you find out the cost of equity and the cost of debt, which I will also explain in a second, and if you weight those costs of equity and that cost of debt by how much of the firm is financed by equity and how much of the firm is financed by debt, those will give you the weights, and that will get you your weighted average cost of capital. So what is the cost of equity and the cost of debt? I'll start with the cost of debt, but the fundamental definition of both of these is similar to that land and rent example that I said. The appropriate cost of these financing sources is the expected return on those financing sources, right? So what is the cost of debt? It is the expected return of cash flows to debt investors. And what is the cost of equity? It is the expected return of the company's equity to the company's equity investors. So what does that mean? I keep saying this, but it's very important that you understand the fundamentals. So for cost of debt means that a firm's debt investors are expecting a certain return on their investment, right? So it's sort of like the interest rate on debt, except usually it's kind of hard to observe or calculate the cost of debt for a company because, well, if you have access to Bloomberg, you can go to a company's debt portfolio or their detailed credit analysis, and you can find out what bonds they have floating around in the market right now and what the yield to maturity or what the market interest rate for those bonds are. And you can take an average of those, and that'll roughly be their cost of debt. That'll probably be a more accurate representation. But the more theoretically solid way of calculating cost of debt or calculating the expected return on debt is, just think about this. If you are an investor, if you're a debt investor, you can invest your money into the risk-free U.S. government treasury securities for the risk-free rate, at the risk-free rate. So right now that risk-free rate is 3.43%. It probably changed today, so I'm going to change that. But let's just say, that it's 3%. You can invest in risk-free securities and you can get a 3% return. But remember what we said at the beginning of the semester, there is a positive linear relationship between risk and return. So if you are investing in an asset that is more risky, you should demand a higher return for those assets. So as debt investors, what does that mean? If you invest in something that's risk-free, if you invest in a US Treasury security, you can adequately demand 3% as the risk-free rate, because that is what the risk-free rate is. You can demand an expected return of 3%. But if you were to put your money into a company's cash flows are nowhere close to being risk-free, because companies can make bad investment decisions, companies can go bankrupt, companies can just not deliver your cash. Well, if you're a debt investor, they're required to, but companies have ways of not guaranteeing those cash flows, even with debt covenants in place that require them to pay back whatever money you owed them plus a stated interest rate. Which means that all that is to say that companies are risky and that they are more than risk-free. They're not risk-free. So if companies are not risk-free, if companies are risky entities, if they're risky investments, that means you as a debt investor should demand a higher expected return in order to compensate for the fact that your cash flows are risky. They're not risk-free. So how does that actually affect the calculation of cost of debt? Well, what we can do is we can start out with the risk-free rate as a base. So what I'm actually going to do is I'm going to start by clearing out these. I'm going to start by clearing out these formulas right here. So we can start by using the risk-free rate as a base. Let's say Coca-Cola was a perfectly risk-free company, right? What interest rate would equity holders demand of, what interest rate would debt holders demand of Coca-Cola if they were to give debt cash flows, if they were to provide debt capital to Coca-Cola? Well, we can look up what the risk-free rate is right now. So there's lots of ways to do this. You can use FactSet. So I'm pretty sure you can go to markets. So this is the FactSet page. If you go to markets, and if you go to fixed income, and if you go to government yields, you will see that the 10-year, let's see. So the 10-year is right now trading at 3.35%, roughly. Because FactSet is a little bit hard to read, also this is for the US, because FactSet is a little hard to read, there are two sources that I would say you can use for the risk-free rate. The first is CNBC Markets. So you can just go to cnbc.com. You can click on bonds, and that will show you US 10-year is 3.353%. So it's actually went down a little bit, I'm pretty sure. Actually, it says that it was up. So maybe I just had my numbers wrong. So 3.35%. I'm pretty sure you can also just go to bonds over here, and you can find a whole list of yields for different maturities. So if you're doing a short valuation, you might want to use a shorter yield for the treasury bond. Like if you're only doing a 1-year project, maybe you can look at the 1 year or the 2-year treasury bond. If it's only a few months long, you might look at the US 3-month. This is a very common metric to determine what the short-term risk-free rate is. Because corporate valuations are very long, you commonly look at 10-year, the 10-year US Treasury. So again, it is 3.353. You can also go to Wall Street Journal market data. Or here, you can just go to wallstreetjournal.com, and then you can go to the market section and then go to market data home. And over here, if you click on bonds, it shows you the 10-year note is, according to them, it's trading at 3.355. I'm not exactly sure why Wall Street Journal and CNBC show different yields. Maybe they're looking at different treasury notes. Maybe Wall Street Journal is constantly updating it. I'm not exactly sure. But maybe this is sort of an estimate of the yield. I'm not exactly sure. I know that I tend to trust CNBC more. I don't know why. Really, my valuation professor told me to use CNBC, and it's not going to make too much of a difference if there's very, very slight differences. And hey, look, now it's saying 3.355. So I'm going to put in 3.355%, and that is the risk-free rate. So if Coca-Cola was completely risk-free, you as a debt investor would demand a return of 3.36% on your investment. But Coca-Cola is not risk-free because Coca-Cola is a corporation. Coca-Cola is risky. As we said, it can go bankrupt. It can have all of its assets be sold off. Its management can make some really bad investment decisions. So because it's not risk-free, you are going to demand some more on that. Now, there are two questions to ask. How risky is Coca-Cola with its debt investors? Sorry. How risky is Coca-Cola with its debt investors? And how do we determine what that premium is going to be? So we know, the way that you determine how risky any company is with its debt investors is you look at its credit rating. So there is a whole list of credit ratings that ratings agencies like S&P, Moody, and Fitch, they release. The most commonly used one, I'm pretty sure, is Standard & Poor's, S&P credit ratings. And A+ is a very good credit rating. So the lower a credit rating is, that means you have worse credit history, the higher that credit premium is going to be, right? That should intuitively make sense. But what is that credit premium actually going to be? So you can go to estimating a synthetic rating and cost of debt. Okay, sure. Yeah. So this link right here is linked in one of the Google Drive files. I can look that up in just a second. I'm pretty sure it's in the shared files in lecture 6, but I can also just paste this link in the Slack. So this page by New York University's Stern School of Business, they released this table saying, depending on what your rating is, what is that spread going to be? What is that credit rating premium going to be, right? So because Coca-Cola's credit rating is A+, it's a high market cap firm. There's a distinction here between low and high market cap firms, but I'm pretty sure the ratings and the spreads are going to be the exact same. Because Coca-Cola is an A+ rated company, its spread is going to be 1.5%. So that's what we're going to put right here, 1.5%. And its cost of debt, very simply, is the risk-free rate plus this credit premium. So the appropriate cost of debt, the appropriate expected return on debt to debt investors for any debt that Coca-Cola issues is roughly 4.86%. So this is its cost of debt. And I will also put in their tax rate because this is going to be pretty important for when we calculate the WACC. So that is the first piece, and I will be back with the cost. I'm going to take a little break, and I'm going to be back with the cost of equity. Great.
Okay. So we are back with WACC part 2. So in part 1, we finished the first piece of the weighted average cost of capital formula, which is calculating the cost of debt. Now what we're going to do is we're going to move on to the cost of equity piece, which is the other major source of financing that all firms generally use. And for Coca-Cola, it's a very, very significant portion of their firm's financing. So if you all remember from a couple of minutes ago, when we did cost of debt, what was the generic formula for cost of debt? And I'm going to write that down real quick. It's that KD, which stands for the cost of debt, KD, K stands for cost in this case. The K of debt is equal to the risk-free rate plus a credit risk premium, right? And I'll italicize that to show that, I will italicize that to show that this is the formula for the cost of debt. And you'll notice that in our cell for the cost of debt, we calculated the risk-free rate and we added onto it a credit premium based on Coca-Cola's ability to pay back its debt cash flows to its creditors, to its sources, to its originators of debt financing, right? So this is the fundamental formula. It is the risk-free rate plus some premium to account for the fact that giving debt cash in the form of debt to Coca-Cola is not a risk-free investment. Because it's risky, you can demand a higher expected return. So the cost to Coca-Cola is higher. If the return demanded by its investors is higher, the cost to Coca-Cola is also higher because it's a risky company. Right now, it's not super risky in terms of its rating. Its rating is very good. It was an A+, so its credit premium was relatively small. But that still doesn't change the fact that it is not risky, right? Or sorry, it's not risk-free. It is still a risky company. Low risk, but still risky. So the cost of equity equation is also going to be very similar. It is KE is going to be equal to the risk-free rate plus some kind of risk premium in this case. Now, for the cost of debt, this risk premium was related to the company's ability to pay back its creditors, like their interest and their principal, right? But what is that risk premium for equity? Well, usually, if you invest in a company, if you invest in a company's stock, what expected return are you going to demand, right? So it's the same for equity. If you invest your money in a risk-free asset, that asset is risk-free. So like a 10-year treasury bond, so that return that you're going to expect is very low because you're not being compensated for taking on any risk. It's no risk. So you shouldn't be expecting a lot in return. But corporations are more risky. So you should be expecting more return in terms of how much return you get, right? Because they're more risky. That is simply how corporations work. And that goes for equity. If you put your money into a 10-year treasury bond, it's not, the value of that bond is not going to increase a lot compared to if you put your money into, let's say, Amazon 20 years ago, and now 20 years into the future, it's worth so much more. And you get that really high return because Amazon is risky. Any corporation is going to be more risky than a risk-free asset. And the same goes for Coca-Cola in this case. Coca-Cola is a risky company, and if you put money into Coca-Cola stock, you should expect a higher return. But of course, the question is, how much more do you expect in return? Well, it's not as easy to observe the risk premium for equity for a specific company. And it's also not easy to do it for debt either, but there are ways to simplify that process, by comparing a credit rating to a credit risk premium. It's a lot more difficult for equity because how do you really measure the excess returns of a company's stock? Well, there's a slight workaround to this, right? So instead of saying that it's going to be one risk premium, it's still going to be a risk premium, but you can break that risk premium up into two pieces. So those two pieces are going to be, well, let me just rewrite the equation here. The cost of equity is going to be the risk-free rate plus the beta of the company multiplied by the market risk premium, which is the return on the market, RM, minus the risk-free rate. So let me explain what those are in a second. So let's focus on this market risk premium piece first. If you were to invest your securities if you were to invest your money in the market, like the S&P 500 index fund, like a Vanguard retirement account where they invest in a big index like the Dow Jones or the NASDAQ or the S&P 500, that can be considered the market. The standard baseline here is the S&P 500. What return should you expect? Like what is your overall expected return, right? So the return of the market is also a little bit harder to calculate, but there are people who do it. There are people who can go through the really advanced math. They use a very large sample size and they come up with an implied expected return on the market. Like if you just invested your money in the market, like how much would you expect to gain? Because there's just so much data available for market prices. So you can actually do that. It's hard and they are purely estimates, but you can find the return on the market. And if you subtract the risk-free rate from that, then you get the excess return on the market, which is if you're investing your money in the market, how much extra return are you getting for that for that investment? Because the market is also riskier than any risk-free asset. That should make sense. So the reason that you can't just have a specific risk premium is that it's hard to profile the amount of risk that an individual company takes. And that's because there's both systematic risk and idiosyncratic risk involved in both for a company's stock price. Systematic risk is risk that affects all companies in an entire ecosystem of the market. So if interest rates increase, that is a systematic effect that affects the valuations of all companies. If there is a pandemic or if there is an economic slowdown, that affects all companies. That is known as systematic risk. Idiosyncratic risk is firm-specific risk. So, for example, if the price of high fructose corn syrup increases, that is going to affect Coca-Cola, which uses high fructose corn syrup a lot in its products, a lot more than a tech company like Facebook. The price increasing of the increased prices of high fructose corn syrup, it does not affect Facebook. So the price increase of high fructose corn syrup is an idiosyncratic risk. So because companies have both idiosyncratic and systematic risk attached to them, it is somewhat easy to measure systematic risk for a firm, but it's really hard to measure idiosyncratic risk for a firm. So what you do in order to find the approximate risk profile of a company is you relate how risky it is to the market. Now, the market is systematic. It is only systematic risk because it is so diversified that no matter what idiosyncratic risks affect some companies in the market, that is balanced out by the fact that you're spreading your investments over a large portfolio of companies. So idiosyncratic risk is erased with diversification. And all you're left with is systematic risk. And if you can find the systematic risk and the expected return premium as a result of that systematic risk over and above the return that you would expect on a risk-free asset, then now you have a risk base that you can compare the riskiness of all stocks to, right? So that is essentially what beta is. So what beta is basically is how risky is any one company stock to the market. And a beta of, so what does that mean? An example is a beta of 2 means that if the market increases by 10%, your stock increases by 20%. And the same goes if the market goes down by 10%, your stock goes down by 20%. So a higher beta means that a stock is more sensitive to changes in the market. Now, this isn't exactly theoretically sound, but like the beta is not super theoretically sound in predicting a company's expected return for equity, but it is the most it is the simplest solution that we have, and it is the most theoretically backed. Like I meant, like in practice, it's not the most sound, but it still works for theory with a lot of assumptions. So a beta of 1 means that you're investing either in a stock that is perfectly correlated with the market, or you're investing in the market itself. So think about it. If you are investing in the market, which is a beta of 1, then what is your expected return on the market? Well, it's the risk-free rate plus 1 times the return on the market minus the risk-free rate. So positive risk-free rate cancels out with the negative risk-free rate, and you're left with just the return on the market, which makes sense. If you're investing in the market, you should expect the return on the market. But for a specific stock, which has most likely a beta that is not 1, you can use the market risk premium as a proxy and then multiply it by your by this multiplier, this beta multiplier, to say if a certain stock is this sensitive to the market, that means its expected return is going to be this sensitive multiplied by the market risk premium. I hope that makes sense. So how do we actually find the equity risk premium? Well, this is something that you have to just look up. So the way that I like to do it is I like to go to this page by Aswath Damodaran. Aswath Damodaran is a professor of valuation and finance at New York University Stern School of Business, and he is known as the father of valuation because he's done by far the most historical research on it. And his website, if you just go to this website right here, he tells you the implied equity risk premium. So this is the market risk premium. Equity risk premium is another It's another term for it. So he says that it's 4.88%, which means that if you were investing in the market, right, that means that your expected return is the risk-free rate plus the equity risk premium of 8.2%. But we are not investing in the market. We're investing in Coca-Cola. And Coca-Cola, we need to find out how sensitive Coca-Cola is to the market. So the way that we do this is we have to calculate its beta. Now, there's two main ways of calculating beta. You can either calculate beta through historical prices. Well, actually, there's three ways. The first is you can go to Yahoo Finance and you can get it. So let's actually do that. Yahoo Finance. And you can go to KO, type in the ticker of, or just type in the name of the company. And that will tell you the 5-year monthly beta, which means, and for Coca-Cola, that's 0.54. So this means that if the stock market increases by 10%, Coca-Cola increases by 5.4%, which should make sense because Coca-Cola is a very stable company with very stable cash flows. They're not doing anything crazy. They're not a hyper growth tech stock or anything like that. And the market has a lot of higher growth companies that are affecting its movement. So Coca-Cola is relatively low volatile. It's less risky. It's not as sensitive to the changes in the market. So because it is 0.54, because our beta is 0.54, now our cost of equity is going to be this risk-free rate plus, and now we take this equity risk premium and we multiply it by this beta, and it's going to be a little bit less than 8.2%. Our cost of equity is 5.99% because Coca-Cola is less risky than the market, so it has a lower cost of equity. That should make sense to you. Now, how would you actually calculate? How would you actually calculate this beta? So there's a way we can do it. We can do it one of two ways. The first is using historical regression analysis, where you look at how you literally take a sample of, let's say, the past 5 years of data, and you compare how has Coca-Cola's stock price moved in relation to the S&P 500's stock price moving. The other way that you can do it is you can look at comps. So comparable companies that are in a similar industry as Coca-Cola, that those companies, because they have the same business, they're in the same industry, companies with the same size, they should roughly have the same risk profile as Coca-Cola. So if you can build a proper comp set for Coca-Cola, then you can take an average of those companies' betas, and that should roughly be what Coca-Cola's beta is. Now, there's a lot of factors that go into beta. There is the fact that a company's capital structure affects its beta. So a company with a lot more debt is going to be a lot more risky. So its beta is usually going to be higher. And a company with less debt does not have as many bankruptcy, financial distress costs. So it's usually going to be less risky. But simply, like, you could do a comps analysis, but I wouldn't recommend doing the comps analysis personally. I like to use a regression, one, because it actually teaches you how to calculate beta using historical data, and two, because the comps method is also very involved. And for companies like Coca-Cola, it's hard to find good comps. There's Pepsi, and really, what else? Like, what other company just jumps to mind as a good comparable company to Coca-Cola, right? So we will calculate beta. I'm gonna pause right here. Hopefully this makes sense, and we will calculate beta next.
Okay, so hopefully we are recording again. Sorry, I had to step out, but now we're back. So let's move on to actually calculating this beta, shall we? So this beta, we can calculate, as I said, one of two ways. We can either use historical data and we can do a regression analysis, or we can use comps. We can use comparable companies and do a quick comps analysis. I'm going to show you how to do the historical regression. You can go online and figure out how to do a comps. Ideally, you should do both, but for the purposes of this DCF, we're only going to do historical regression, and for the purpose of the stock pitch competition, you really only need to do historical regression. By the way, you don't really need to show this to us, but we hope that you do calculate beta on your own, because I think it's a good exercise in understanding Excel and understanding actually what is going on between the relationship between your target company stock price and the price of the market, right? So what I'm gonna do is I'm gonna first open up a new sheet. Alt-HIS is the keyboard shortcut for that. Alt-HUR to rename, and I'm gonna call it beta. Alt-PVG to remove the lines. Okay, so the first thing I'm going to do is I want the date, and well, here is where I'm actually going to deviate. So technically, beta is, I said it was really just the returns on the stock, commonly called RI, or the return on the investment, versus the return on the market. And you do a regression of the returns on the stock on the y-axis and the returns of the market on the x-axis. But in reality, what we need to do is, it is the excess return on the stock above the risk-free rate versus the excess returns on the market above the risk-free rate. Now, in the past, you didn't really need to do this because the risk-free rate was zero. For a long time, it was zero, and historically, it was zero. Where you do need to do this, though, is if interest rates have been fluctuating a lot in recent times. And, well, we just happen to be in a time where interest rates have gone up nearly 500 basis points since last year, right? So we need to reconcile. That can actually make a relatively big difference in our analysis. At least the short term, U.S. Treasury went up by 500 basis points, but the 10-year also increased a lot. So this can make a big impact on our regression analysis. So we actually need to account for the risk-free rate too. It's not too complicated. It's just one extra step, but this is just being accurate. Okay. So the first thing that we need to do is, well, what is our date range? So we're going to say 5 years. Usually 5 years of data is 5 years of historical data is enough to account for getting a big enough sample size for us to have a meaningful regression. And also it will it's short enough to where there's not too many external economic factors affecting it. Like, we're right now with 5 years of historical data, we're going to be fully capturing the economic effects of the pre-pandemic, mid-pandemic, and post-pandemic economy, and how that has affected both the market and the risk-free rate and Coca-Cola's stock price. So 5 years of data is what we're going to use. So the first thing that we need to do, let me quickly format these. So we need US 10-year Treasury rates, because again, this is the risk-free rate. This is the proxy for the risk-free rate that we're going to be using. So where do you go to find that? So we're on Excel right now. Move over to Google and go to the Federal Economic Database, and go to the St. Louis Fed. This is also called the Federal Reserve Economic Data. This is a big website posted by the St. Louis Federal Reserve Bank. And they have a lot of data. So to find monthly risk-free rates, so we're going to do 5 years of historical data monthly. You can type in GS10, and that will get you the market yield on US Treasury securities at 10-year constant maturity quoted on an investment basis. This is exactly what we want. GS10, go to this website, pretty simple, click on this. Now, once you get here, right now it's showing you the max 2023 all the way back to one of the first US 10-year treasuries in 1953. So we only want 5 years, so make sure you click on 5 year and make sure that it's giving you what you want. Right now, we do want it in a percent. We don't want it seasonally adjusted, and we do want it monthly, and we want to make sure that it's the 10-year US Treasury, okay? So go ahead and download this. I'm going to download this as a CSV. I'm going to open it. And this is going to give me quite a bit of data. So it's going to start at, it's going to start at March 1st, 2018, and it's going to go all the way down to March 1st, 2023. I'm going to copy that. I'm going to move over to my Excel over here. and I'm going to paste it in. Now, I only want the value, so I'm going to do Alt ESV. I guess I want Unicode text, please. Yep. So now I have a whole list of values. Oops. Come on. Yeah. I have a whole list of values, and this is really important. Okay. Now, we have 3/1/2018 all the way to 3/1/2023, right? So there are two things that we need to change here. Let me just quickly delete this. You all know that, or I'll just move it up here. The beta regression is going to be the excess return on the stock against the risk-free rate. So this is why we need the risk-free rate. So risk-free rate. We can't just use this data. Why? Well, the reason is that first, these risk-free rates are annualized, but we want them in monthly terms. So, oh my gosh, Alt HOI, please. Hey, actually, I'll make this a little bit bigger. Let's make that 12. Worrying about formatting here. So this number right now is an annualized percentage. We need to get this into a monthly percentage. And right now it's in a whole number and it's not in a percentage, right? So in order to get this into a percentage, we need to divide this by 100. And we should also divide it by 12 in order to get into a monthly risk-free rate. So divide that by 12. You could also just divide it by 1200, but I like to first divide it by 100 and then divide it by 12. 1200 should give you the exact same answer anyway. Alt HP to convert it into a percentage. I'll move that out to 4 decimal places, and let me move that down. So one thing to remember here is these dates, right? What does these dates represent? So you can kind of block this from your mind, but what's important is all of these risk-free rates are forward-looking, which means 0.2367% is the monthly risk-free rate for the month of March. So 3/1/2018. So this 0.2367% is the risk-free rate that you would get on an investment from the beginning of March to the end of March. This 0.2392 is from the beginning of April to the end of April. All the way down here to 0.3050, which is from the end of March, the beginning of March 2023 to the end of March 2023. That's a little bit of a problem. I'm right now recording this on April 5th. So what about the risk-free rate for April? Well, we can't really observe the true value of the risk-free rate for April. So what we're going to end up doing is if I do this plus 30, never mind, plus 31. Yeah, so for 1/2023, the risk-free rate, we're just going to say our best approximation of that is the previous month's risk-free rate. So let me just do Control C, Alt ESF to get that into a formula, and Control C, Alt EST to get the same. So I really just wanted the same. The best approximation that we have is that it's just going to stay as last month's risk-free rate for this month's investment, or I guess this 4-day investment, right? Okay. So that is our monthly risk-free rates. Now, so that covers the treasury piece. Now we actually need to go and get our return data for the market. So let's go and do that. The first thing I'm going to do is I'm going to leave a little bit of space. A nice way to do that is to leave a column of space but make that column very thin. So I usually use a width of 2 right here. I'm going to go for the date, and we're going to use the S&P 500 for our base. So where do we go and find that? Well, go to FactSet. I'm going to move over to FactSet right here. I'm going to go to S&P 500. S&P. SP50 is the index right here. So I'm going to go to the snapshot of the index. Okay, let's go to prices. Let's go to price history. And this is going to open up this tab right here. Okay, so I want 5 years ago. So yes, I do want 5 years of history. It's giving me the prices, which I like. I want the dates in reverse chronological order. So this is going from the end of trading day on April to so is it giving me, let's see, is this giving me weekly data? How can I get monthly data? Yeah, go to monthly. You can always play around with these settings. So yeah, if I bring that down, yeah, so now this is giving me end of April through the end of May, so that's for the month of May. And let's see. What's the most recent day that it's giving me? Yeah. So let's see how many data points that gives us. Hopefully it should be giving us the same, but no problem. So we have a list of prices, we have a list of dates, and really that's all that we need. Okay. So I'm going to download this. I'm going to download this as a spreadsheet. I'm going to open the spreadsheet. Oops. Open the spreadsheet. Okay. All right. So give me this and this. Copy that. Move over here. And Alt E S V. Unicode text, please. HOI. Yeah. Sure. Okay. So yeah, that makes sense. So what we're going to do is we're just going to move these down one so that this, yeah. So this is an investment for the month of, yeah. So we actually don't need this one row. Gotcha. No, we don't need that one row. Okay, so this is the S&P 500. This is the S&P 500 index. I'm going to make it a little bit bigger. Called HOW, make that 10. Sure. I'm going to make all of these center aligned. And now you can calculate the returns on S&P, on the S&P 500. So if I do returns, so what are our monthly returns going to be? So it is going to be, so this is for the month of May, right? For May 2018, because it's going from the end of April to the end of May. So it's for the month of May. What is your return? So you're going to have to skip the first month of data, but the return is going to be that month's price minus the previous month's price divided by the previous month's price. So Alt HP, you got a 2% return. Go 2.16, which means if you invested in the S&P 500 on 430 at this closing price, and if you waited a month, that was your return. And you can double click that to take it all the way down. So we have how many months of data? We have 60. That's good because that's 5 years. We have 60 returns. That is very good. Okay, so we can do the same. Actually, we don't even need that risk-free rate because all of these returns are going to be against this risk-free rate. So now let's look at excess returns. So this is just going to be the S&P's return minus the risk-free rate. Don't need that many decimal places. An easy way to fix that is to do Control 1 and go to, let's say I only want 2 decimal places, so I'm only getting 2. Alt HOI, there we go, excess returns, and copy those down, Alt HAC, these are centered, these are centered too. Wasting a lot of time on formatting, but that's totally fine. And we're gonna do the exact same with Coca-Cola, so Alt HOW to, I actually don't even need the date header here. I'm just going to say KO and Alt HOI because these dates are going to be the exact same because, well, Coca-Cola and the S&P 500 will trade on the same days. So our range should go from 430 to 45. 430 2018 to 45 2018. So let me close out of this, close out of that, and let's go back to FactSet and let's get historical prices for Coca-Cola. So KO, snapshot, price history, same thing, same deal. 5 years ago, monthly, that's what we want. Let me refresh this page because sometimes FactSet can get a little whack. Yep. Okay, so make sure that the dates are in in chronological order. And we have a list of prices, 5 years, monthly, good. That seems good to download. Download as a spreadsheet. Once it downloads, open it up, get the price and the date. Actually, we don't even need the date, but I'm going to get the date just in case. And I'm going to move over here. Okay, let me insert a column for the date. Okay, let me just move these guys over one. And let me get the date over there. And let me Alt ESV. Oops, hate it when that happens. Alt ES. Oh, is that not happening? Maybe because I'm not copied. Alt ES Unicode text. Totally fine. And just make sure that these dates align. So I'm gonna Alt HOI to make sure that those are Alt HOI, buddy. Okay, cool. 4/30/2018 all the way down to 4/5/2023. So our dates do align, which is good. That means we can just delete this column and we can just use these prices. I'll quickly convert these into dollar signs. And the same here, convert those into dollar signs. And Alt HAC, please. Okay, cool. So now, same calculation for our returns. If you invested in Coca-Cola on 4/30/2018 at $43.21, what would your investment be for the month of May? Well, this is going to be equal to May's price minus April's price divided by April's price. So you're losing a little bit. Alt HOC, please, and then we can copy those down. Alt HOI, excess returns, and now we can calculate the same excess returns against the risk-free rate. So it is KO's return minus the risk-free rate. Boom. Do control 1, please. I only want 2 decimal places. Center that, center this, copy all the way down. Great. So now we have excess returns. We have RM minus RF, the return on the market minus the risk-free rate for 5 years of data. And we also have RI minus RF, the specific returns on our stock minus the risk-free rate for the past 5 years. And we have 60 months of data, which is exactly what we wanted. So how do we actually calculate beta? We can calculate beta of 2 ways. So you can calculate it using the slope formula, and then you can calculate it using the covariance divided by variance formula. Okay, what are those specifically? Let me quickly color code these to show what our betas are going to be. Okay, so the slope formula is very simple. What did I say that our regression was going to be? It was these on the y-axis. So these are the excess returns of our specific stock on the y-axis and the excess returns of the market on the x-axis. So we can do that with the slope formula. So if you go equals slope, our known y's are going to be the excess returns on Coca-Cola stock, comma, our known x's are going to be the excess returns on the market, and we get 0.5442. And lo and behold, this is roughly, control B, control B is right here, HAC, yeah. This is pretty similar to what Yahoo Finance had, right? Another way that you could do this is you could use the more financy formula for this. The technical definition of beta is that beta is equal to the covariance of RI minus RF and RM minus RF. So the covariance between this series of excess returns, the series of KO's excess returns and the series of the market's excess returns divided by the variance of RM minus RF divided by the variance of the market's excess returns. If you're curious about how you calculate or how you derive this formula, take a class on investments, so investment management, or take valuation. Again, they will teach you this. So you can do this the same way. So covariance.s, this is a sample. So this is the first array. This is the second array. Divide that by var.s, yep, and then grab those excess market returns. That's totally fine, that's totally fine. What's happening, what's happening, what's happening? Yes, fine. Whoa, 0.54. Yeah, but it's giving me the same answer. It's just giving me a weird, there we go. There we go. They're the same numbers, guys. They're the same numbers. Don't worry. So you'll notice that both equations get you to the same. For your own understanding, I might recommend using the slope formula, but honestly, it doesn't matter. They both get you the same answer. This is if you want to look cool and impress your friends and say, hey, I can use the covariance divided by variance formula to calculate the beta of a stock. That was very exciting, I know. You can use this formula or just use the slope formula. One thing I want to do is I want to show like what this looks like. So if I grab this series of returns and I also grab this series of returns and I insert a chart. How do you insert a chart? Not letting me. Not sure why it's not letting me insert a chart right now. I want to insert a chart. Okay, maybe I'm doing something. Insert. Weird. I don't know why it's not letting me insert a chart. Normally it lets me insert charts. But if you inserted a chart, it would actually show you the regression of what the stock price of KO was, or what the returns of KO is versus the returns of the S&P 500. And what do you expect that slope to look like? It's going to be less than 1, because if the S&P 500's price increases by 10%, Coca-Cola is only increasing by 5.45%. That means it's not as volatile as some other stocks like Amazon or Apple or any tech stock, which probably has a relatively high beta. So that is, in essence, how you calculate beta. It was a relatively simple process. All you really need to do is go to the Fred economic database and get the US 10-year rates, get monthly 10-year rates, convert them into monthly risk-free rates, then go to FactSet or any database of your choosing, download how many ever years of historical data, convert those into monthly returns, and then use your risk-free rates to convert those into excess returns, and do the same with your stock, and then use the slope formula to calculate the beta of your stock. I would say that's simple. I don't think that's too involved of a process. So how do we actually use this in the CAPM? Well, instead of 0.54, we're going to make it 0.545. Oh yeah, but we can feel more proud about this beta because that's something that we calculated. So I'm just cell referencing that beta sheet, and instead of 5.99, it went up to 6.01. Big deal, right? Okay, but now we have our cost of equity. So I hope this section on the cost of equity made sense. I hope it makes sense of why we're taking the risk-free rate and we're adding on a premium for the riskiness of our company. I hope it makes sense about what the market risk or equity risk premium is, and what beta is, and how we calculate it, and how we can combine the beta and the equity risk premium together to find the excess risk premium for our specific stock, and then add that onto the risk-free rate to find our appropriate cost of equity. So we have our cost of debt and our cost of equity, but we're looking for one number. These are two numbers right now. So how do we get these into one number, So, we have a certain cost of debt for debt providers for Coca-Cola. We have a certain cost of equity for shareholders of Coca-Cola. What is Coca-Cola's discount rate going to be? Well, it depends on how much equity and debt financing Coca-Cola actually has, which is what this piece is over here. And what we're going to do is we're going to find out how much of Coca-Cola's market value is equity, how much of it is debt, and we're going to weight those, and we're going to weight the cost of debt and the cost of equity by those numbers. So the market value of equity is the market cap of the firm, which means it is its share price multiplied by its shares outstanding. And because this is slightly outdated, actually, first I'm going to divide this by 1,000,000 to get this into millions. Very, very big firm, obviously. But this is probably not the most current share price. So I'm going to go, so Coca-Cola is right now trading at $62.80. Also, I could just go to our beta and find that it is at 6280. I didn't even need to go to FactSet because we were already doing that. Let's put in 6280. Right, so our market value of equity is a little bit more. Okay, the book value of debt. So technically you should use the market value of debt here because we're trying to find the market value of the firm, the total market value of the firm. But the market value of debt is hard to observe for a company because bonds are not usually just trading around and well, they are, but it's just hard to observe the prices of those bonds. So generally you use the book. In practice, you end up using the book value of debt. So what is the book value of debt? Well, it's all of the debt that that Coca-Cola has. So if we go over to our statement sheet and we go to the balance sheet, right now we're on the cash flow statement. Let's go to the balance sheet and let's look for all debt-like items. So long-term debt. So we're going to get the most recent long-term debt. To that, we are going to add current maturities of long-term debt. So this is short-term debt. And to that, we're going to add loans and notes payable. So these are the three items that I would look at. Also, I will mention that right now we are in what for Coca-Cola is Q1. Sorry, we're right now in Q2, but their 10Q for the first quarter of 2023 has not been released yet. So we're using the most recent financial data available to us to find out what Coca-Cola's debt position is right now. So if, let's say this was June of 2023 and they already had financial data available for their Q1 balance sheet, you would use that Q1 balance sheet from their 10Q, which is probably going to be released in late May, April, or even early June, I imagine. These companies take a while to combine all of their financial data and actually release it to the SEC and release it to the public. So you might not be getting the most updated information immediately, right? This is the most updated that we have, but know that if there's a more recent financial document, financial filing available, you should always use that financial document's balance sheet, not their income statement or cash flow statement, because those are periodical. And we are looking at annual numbers, so you should always use the most recent 10K for the income statement and the cash flow statement. But since the balance sheet is just a snapshot, you should use whichever most recent filing there is, and that will show you the entire company's asset, liability, and equity position. So that's pretty much all I have to say. So these are the three line items that you should be looking at. Loans and notes payable, which is short-term debt. Current maturities of long-term debt, which is the debt that of their long-term debt, any debt that's due right now, and long-term debt that's due more than a year from now. So these are the three items. So it has 39 billion. It has 271 billion in equity. So obviously this is a very heavily equity financed company. Or at least equity is the main market, is contributing to most of the market value of Coca-Cola. So what is the weight of equity? This is relatively simple. Of this total percentage, how much of that is the market value of equity? Well, this is going to be equal to the market value of equity divided by the sum of these two, 87.4%. And the weight of debt is going to be equal to 1 minus this percentage, so 12.6%. So now that we have the weight of equity and the weight of debt, we can apply these weights to the cost of debt. But it's not just as simple as a weighted average, because we need to, well, it is for the cost of equity. So the WACC equation is here as I have presented it. The WACC is equal to the weight of equity times the cost of equity plus the weight of debt times the cost of debt times 1 minus the tax rate. And the reason that we include 1 minus the tax rate here at the end is that any debt that that Coca-Cola takes on is going to be interest expenses, which they can then use to reduce their taxes, because interest expenses for accounting get taken out before net income. So because interest expenses get taken out before net income, that means, or before taxes are affected, that means their taxes are decreased. So their effective taxes, their after-tax cost of debt is lower. So this is the pre-tax cost of debt. This is a little bit higher, But for WACC, what matters is the after-tax cost of debt. Again, if that didn't make complete sense to you, honestly, just trust the process. And if you're confused about it, ask a finance professor, take investments, take valuation, and they will explain more of the fundamental theory behind this formula as it exists. So, but we're just going to go ahead and plug it in. So open parentheses, this is equal to the weight of equity times our cost of equity, close parentheses, plus our weight of debt times the cost of debt times open paren again, 1 minus the 21.1% tax rate. Boom, and we have our WACC, our weighted average cost of capital is 5.74%. And this beautiful number is the discount rate that we are going to be using to discount these future unlevered free cash flows. This is the best approximation that we have at finding a discount rate that appropriately represents the risk of these cash flows to Coca-Cola's investors, to all of their investors, both equity and debt. And thus, we have finished attaining the second piece of the valuation analysis that we need. We spent all of this time trying to get to unlevered free cash flows, and we've spent all of this time trying to calculate the weighted average cost of capital and the appropriate discount rate to discount those those future cash flows into the present with, or present by. And now we actually have to put those two together, and we will do that in the next segment of this video. So I hope that was helpful. Try this out on your own. Go to all of these websites. Go get this data. Calculate beta on your own. It really is a lot of really good Excel practice, and it's a lot of fun. So I hope you try this on your own. Let me know if you have any questions on this piece. And in the next piece, in the next segment, we're actually going to be discounting the stage one cash flows to the present. And after that, we'll just have to deal with the terminal value, and we'll pretty much be done after that. So it's very exciting. Good night. We'll see you in the next segment.